Accounting for inventories. And in this module, we will learn classification and valuation of inventories. Very important topic. Okay. So when we say classification, the inventories are classified into material and supplies inventory, work in process inventory, and finished goods inventory. If you do remember that we have used all these three classes of inventories in the manufacturing account. So material and supplies inventory, we have discussed that these include direct material, these include indirect material, and this also include the office supplies and shipping supplies. Okay, the direct material inventory is adjusted with the purchase of direct material, and ultimately we get direct material consumed figure, which become part of the prime cost. And indirect material inventory is adjusted with the purchase of indirect materials, stores and spares, etc. And its consumption is taken to the factory overhead cost. As far as office supplies and shipping supplies are concerned, these are administrative expenses and selling expenses respectively. Obviously, the inventories of office supplies and inventories of shipping supplies will be adjusted over there. Work in process inventory, we know very well that these are worked out to calculate cost of goods manufactured, and finished goods inventories are worked out to calculate cost of goods sold. So these are the three classes of inventories. And when we talk about valuation of inventory means measurement of inventory. The accounting policy is that inventories are valued or measured at lower of cost and net realizable value. Whatever is lower, the cost or the net realizable value, we will measure our inventory at the lower amount. But this valuation is done on item by item basis or on group basis. When we say item by item, it means if we have 10 items of inventories in our inventory list, all those 10 items will be worked out for their lower of cost and net realizable value separately. Or if there is a group, we can group them. Those 10 can be grouped into 3 or 4 groups. Then we will work out their cost and net realizable value on group basis. Anyways, inventory is valued at lower of cost and net realizable value. What is cost? That we have paid to acquire the inventory, which is the cost of purchase plus the conversion cost. Okay. And what is net realizable value? That can be realized by selling the inventory, which is estimated selling price minus further cost to sell. We have discussed its definition in detail, that further cost to sell includes cost to make such sales and cost to complete such production. Okay, cost of completion and cost of making such sale. It includes further cost to sell. This diagram is very important, in which we see that valuation principle is that it should be lower of the cost or the net realizable value. Okay, what is cost? Cost we can work out through two methodologies. One is used for mutually interchangeable inventories. Okay, and second is used for specifically identifiable inventories. When we say mutually interchangeable inventory, these are the inventories for which we don't have any specific identification. For example, furniture items. Supposedly, we are manufacturer of school desks, and each of the school desk is 100% similar to the other. It means if any person, means our customer, wants to buy 1000 school desks, we have supposedly 3000 school desks available in our inventory. That customer will not have any issue to have any number, to have any school desk in which like that 1000 number will be completed. So we can give any of the 1000 school desks to that customer, and that customer will not have any objection, or selection is not a matter over there. Or very simple example you can take, if you are in the market to buy sugar, you will just order to give me 1 kg or 5 kg sugar, and you will not have any choice that this sugar is acceptable or this is not acceptable, if all the sugar available over there is of same quality. Okay, so that is not interchangeable, or that is mutually interchangeable inventory. So when the inventory is mutually interchangeable, its cost will be worked out through first in first out method or through weighted average method. Okay, we will learn these two methods in the upcoming section. For specifically identifiable inventory, which is in fact not interchangeable, we use individual cost method. First of all, what are these types of inventories? Let's take an example of furniture once again. If we are dealing in design furniture, designed sofa or designed bed, these furnitures would be different from the other. Or one more example, which is very easy to understand, jewelry. When you are in the shop for buying jewelry, the jewelry sets are not interchangeable. These are different from the others always in normal circumstances. So in that case, we cannot use first in first out method or weighted average method. For that, we will be having individual cost associated to each specifically identifiable inventory. Okay, well, so this is the calculation of cost. Then net realizable value for finished goods and work in process. As we know, there are three classes of inventories. One is material and supplies, one is work in process, and one is finished goods. So these are the three classes of inventories. For finished goods and work in process, the formula is estimated selling price less cost of completion less cost to make such sales. All are estimated. Okay. And for material and supplies class of inventories, the net realizable value is replacement cost. We will work out its scenarios, and then we will see that what is this replacement cost. So the ITTRs to this module are that, in fact, there is only one ITTR in this module, that for assets to be reliable, you know, the accounting phenomena that we put in balance sheet or even in income statement, that should be reliable. Okay. For the assets to be reliable, a prudent view must be taken. And what is the prudent view? That assets should not be measured at the value that we cannot recover. Okay? Should not be overstated in a way. So the asset that we cannot recover, the value of the asset that we cannot recover, we should not show that in the balance sheet. This is in fact what we do in accounting for inventories. While measuring the value of inventories, we see if the cost of inventory cannot be recovered by selling it out, we reduce the inventory to its net realizable value. So this is the prudence concept which makes the asset inventory reliable. Okay, so thank you very much for your attentions.